Here's the promised voice we've all been waiting for. The right thing to do is just to remain owning the private sector banks. That's the word coming in from none other than Chris Wood from CLSA. The Eternal India Bull believes that India has a large scope to outperform as the investment cycle revives. Nikunj caught up with him on the sidelines of the Voyage 2018 conference, and here's an excerpt of that exclusive chat.
Chris Wood, always a pleasure to have you on ET Now. Our viewers, they always look forward to your views. What do you make of this entire banking scam issue? Do you think this is just like bad weather, this will also pass through, or this time we need to take notice of it seriously?
Well, there's been a bad banking issue in India for several years, and so I'm hoping all this news flow creates more determination on the part of the government to let the whole bankruptcy resolution process work as outlined in the current new legislation.
But are things moving in the right direction, whether it's NCLT or the way RBI is not trying to sort out NPAs? You think, are things moving in the right direction for Indian banks?
Well, there's specific timelines, right? So under this whole new system, so we just need to see if the time deadlines are implemented, in which case there will be resolution.
But Chris, a lot of bad news has come to fore this year. Inflation is moving higher, crude prices have moved higher, there is a local bank scam, in general earnings are not great, flows and LTCG tax again a concern. Yet Indian markets have not fallen apart. We are down 5-6% from the recent high. In absolute terms, we are still flat.
No, I would say Indian markets behave remarkably well given the news flow. So there's clearly the monetary tightening concerns, I think, are lessened by the fact that the central bank has been relatively hawkish. So the RBI has maintained real interest rates. So that to me has made the currency more resilient than it would normally be, because we have some evidence of fiscal slippage. We have concerns about growing populist policies ahead of the general election. We have a higher oil price. Historically, that would have led to more rupee weakness than what we've seen to date, and I think that's explained by the relative hawkishness of the RBI. So I think people are beginning to think the RBI may have been right to be more hawkish. From a foreign investor standpoint, they're looking at dollar returns, so the fact that the rupee is not being very weak is a positive. But I agree, the long-term capital gains tax to me is an unfortunate decision when you had big inflows finally coming into equity mutual funds. So I think another big issue for this year in India is what happens to these inflows. Do they suddenly stop? If they suddenly stop, that will definitely be negative, because foreigners will not, in my view, fill the gap.
Do you think in general, Mahesh and his team and other analysts in India, they've been very optimistic about earning projections, because we start the year with a double-digit estimate, we end the year with a low single-digit number. Will FY19 be different, or we could again see the same pattern?
It's possible, but the foreign investors are not necessarily believing the earnings forecasts.
So what should be
But to me, the big macro issue is all about whether a new investment cycle gets underway in India. And one of the reasons the last investment cycle peaked out back in 2008, and it's been so long coming back, is this asset quality problem in the banking system. So ultimately, the chances of investment cycle really coming back grow much more dramatically if the problems in the banking system are sorted out.
Chris, when I spoke to you in the month of Feb, you had gone underweight. You reduced your...
No, I haven't gone underweight.
You reduced your ownership to India.
Yeah.
It was a triple overweight, now it's a double overweight. After that, we saw a sell-off in within small cap stocks, and markets have come down 5-7%. Are you getting tempted again to revisit your allocation?
No, I'm not. No, I'm happy to stick with double overweight now. That's probably a bit too high, frankly, in the short term. But what I'm going to be watching for is this issue on the banking system, which in the next 3 months, we're meant to be coming up with deadlines, I believe, on the first tranche of NPLs. So we need to see what progress is made on this. So that's the first thing I'm watching. And the second point I'm watching is this issue of mutual fund flows, and if they hold up.
The data is indicating that mutual funds flows are slowing down, but do you think a 10% tax could change them dramatically, or this is just going to be a small adjustment?
Well, I'm hoping it's just a small adjustment, but there's a risk that it's more. I mean, to me, it's just an unfortunate development. I'd be much happier if the tax was as it was before, just a short-term capital gains tax.
Chris, why are consumer stocks in India going up on a daily basis? You got stocks like HUL, Titan, a stock which you track, Jubilant FoodWorks, a stock which CLSA tracks. Some of these stocks are trading at P multiples of 50, 60, 70. They were expensive 2 years ago, and in last 2 years, markets have been volatile, and these stocks have become much more expensive.
Because people will pay up where they believe the growth is assured because there's a lack of growth elsewhere.
2017 we saw synchronized global growth. It was also fueled by a lot of liquidity. Now cracks are opening up. Interest rates are likely to move higher. There could be a fear of trade war. Do you think best of the global growth gain days are also behind us?
No, I think it wasn't really. People called it a synchronized global recovery. I think it's more a series of happy coincidences. And Europe finally accelerated because there'd been no real recovery since 2009. So we had a pent-up demand come through in Europe. The latest data suggests that may have peaked out in terms of Eurozone cyclical momentum. In China, at the margin, China will slow this year because of the deleveraging campaign. The US is definitely going to see stronger growth this year than last because of US tax reform, but a lot of that growth, in my view, will be front-end loaded. The other point to note about the US economy is that for several quarters, consumption has been running ahead of income growth. So the savings rate has basically fallen to very low levels again. So that's not really, I don't believe the US cyclical acceleration is as positive as many people think. I think base case for US growth is around 2%. But next year, if Donald Trump does a big infrastructure stimulus, then we could get another cyclical jolt to US growth like we've had this year on the back of the corporate tax cuts.
So who will benefit because of corporate tax cuts?
The corporates will benefit and the shareholders, and it looks like corporate tax cuts will lead to a renewed surge in share buybacks, helped by the one-off corporate repatriation rate to encourage American corporates to bring their money back from offshore. So the latest data suggests a sharp pickup in US share buybacks.
3 years henceforth, if we interact in the same forum, let's say 2020 or 2021, what kind of world market scenario do you think we could be staring at?
Well, in India, the market will be higher, definitely, if an investment cycle is resumed. If an investment cycle is not resumed in the interim, then to me, that's the key variable for India.
But you don't think that we are nearing the end of any of the big global bull markets? Because the talk in the town is that, okay, this has been a long bull market for US, started in 2009.
In the US I have a different view. So I'm firmly overweight Asia emerging markets, but I would say in the US there is a material risk that the S&P peaked with the February sell-off.
But in general, for our Indian audience who track you very, very closely, and your word, they take it, literally as an indication of how they should plan their portfolio. Your view is that we should not run away from the sell-off.
No, I wouldn't be exiting all my Indian equity positions, but my portfolio is very much concentrated in certain areas. So the areas I want to play most are affordable housing in India, which I think is a 5-year story. And I want to play the real estate sector based on the consequences of this RERA legislation, which I believe will lead to a healthy consolidation.
And between HFCs and private banks, which is a better one?
No, I'm sticking with private banks.
So you would say if one has to do
if I own 3 areas in India, it would be private sector banks, affordable housing plays, and residential real estate consolidation plays.
Okay, you've been wonderful, and thank you for your time, and thank you for accommodating this interview.
Thank you.
Thank you very much.
Hopeful of Indian banking mess resolution soon. That's the big headline coming in from Chris Wood of CLSA, but he still believes that the hiding area is the high quality large cap private sector banks which haven't been marred by any controversy. So, I think the names over there are pretty obvious. But
the sense I got from him that he says, look, pharma is just too complicated for me to understand. And I will not buy pharma because there are just too many wheels and within wheels which you need to understand. A headline came 2 days ago that Amazon may not get into the US pharma business. That changes the way how the generic pricing in the world is going to move. I'm surprised nobody is talking about it. It's yesterday's story. So that's something which nobody anticipated. First, nobody anticipated Amazon to enter into the pharma business. And when Amazon enters into a business, they never pull out that easily. So here entry and exit of Amazon in the US generic business has surprised everyone. So that's what he was trying to tell me. Also, he's very bearish on US. He feels that the peak for US market for this year has been made. He also feels that you may not see a long trade war, but he says the productivity levels in America are so high that you are unlikely to see a further indication, further improvement on that. And he was in general worried about the entire FANG group. He said that markets, the regulatory action will not be supporting some of these group companies, because some of these FANG names, because they've become too large and these businesses are almost reaching a virtual monopoly. And typically when you reach such large virtual monopoly levels, global regulators will take notice of it and they will start breaking the businesses down. So on that account, he was very bearish about US. India, he feels this year would be okay returns. China will give you better returns. But when I asked him on specifically about ICICI Bank and Axis Bank, he said, look, I'm talking about private banks, guys. These are quasi-private banks, because they were old private banks which have become private, old PSU banks which have become private banks. So what he likes are just two names. ICICI Bank, HDFC Bank, to a large extent Kotak Mahindra Bank, and then somewhere there is a tilt towards IndusInd Bank.
So he's sticking with the cream, basically. That's the view coming in from Chris Wood of CLSA. And he also talked about the fact that he was completely against the implementation of LTCG, that's the long-term capital gains tax, and he's saying that may have some repercussion on mutual fund inflows, and if that be the case, then definitely there is a challenge in place for Indian markets, because he's saying the FII money can't compensate for the kind of strong DII flows which have been keeping the market aflush with liquidity.